Welcome back. Thanks for stopping by. Marcus Auerbach here with another real estate market update for the greater Milwaukee area, this time December 2021. Can't believe it's been another year, another 12 months on the books. I hope it was a really good one for you. For the real estate market, it was a very interesting, a very challenging year, and it was also a record-setting year, so we're going to talk about this in a moment. But I also have some news in terms of big things that are shifting and changing in the marketplace that are going to have a big impact on how real estate is going to perform next year. We're talking about inflation. We're going to talk about what the Fed is doing, what that means for interest rates, and what all of that is going to mean for buyers and for sellers in the local Milwaukee market. But before we get there, as always, let's take a quick look at the latest numbers, which I have here. So inventory has been up, 3,717 homes for sale, and out of that, a record number of 2,700 homes sold. So almost everything that came on the market sold, and it sold for a median sales price of $260,000. That is way up, and specifically if you look for Milwaukee County, inventory is up really by a lot, almost 35% more inventory in November. Sales are up as well, and look at the prices. $217,000 is now the median sales price for a home in Milwaukee County. That's up 11.6% over last year, and that is really a huge increase. Now, those are not the final numbers. That's November, but the December and full year numbers will come in pretty close to that. Now, as always, for comparison, I have here the market from 2015 because that is a great benchmark. Compare this, we had 12,000 homes on the market in November and we sold 2,100. So there was over 10,000 houses left to look at. So no wonder people are saying there was a lot of inventory. If you compare this with going on right now, from 3,700 we sell 2,700. So there's only 1,000 left in terms of inventory that you can look at. Now, in terms of price, we had a really big increase here, 11.6%, but we're still much cheaper than the national average at $312,000. So if you compare Milwaukee with other cities in the nation, we are a very attractive housing market because prices are still comparatively low to the rest of the U.S. Certainly to the East Coast and the West Coast, where home prices are a lot more than the 312 we have as a national average. One thing that is interesting is that the national prices went up 19.4%. So that's a completely unprecedented increase in home value gains. I'm happy, that Milwaukee was not that crazy with 11.6% increase. That's a lot more modest, a lot more moderate, and I do think that is a good thing. We have managed to sell as a market a total of probably around 9,250 homes. So that is going to be a new record. Never have we sold more than 9,000 homes in Milwaukee. It's 14% more than last year. And in order to sell over 9,000 homes, you certainly need to have that inventory to sell those. So when you look at it this way, the inventory is there. It's just selling a lot faster, and that's why it feels like there is nothing on the market. It just comes on the market and it sells right away. All right, so let's take a look at what's going on with buyer activity. We are here at the end of the year. 2021 is the orange line, and you can see activity is dropping down in the next days to basically 50% of what we have, half of what we have seen at the beginning of the year, which was very challenging with COVID. So we're going to see how January is going to start this year, but it's going to be approximately twice the activity that we have now. I do think that this year we are going to ramp up faster and sooner. There's going to be more sellers on the market quicker, and we certainly have a lot of buyers in the market as well. Let's take a look at sold to list ratio. So this means how much on average you have to pay for a house over on the asking price. And on average, historically, this is always around 95%. So this year, of course, was a shocker. Over 106% have people paid on average, so 6% more than what the list price is. This has come down now as expected, but we are not seeing it break the 100% line. And this is a phenomenon that I refer to as downward stickiness of prices, because sellers are just not willing to budge that much on their list price. They would rather wait until the next spring market, hold on to the house for another 2-3 months, and then sell it then. So why do I believe that the housing market is going to ramp up sooner and faster in January and February than it is in previous years? One of the reasons is because we're seeing a change in behavior on the seller side. So This is the first time that I have actually data that I can show you about this. This chart is showing you how long on average homeowners are hanging on to the home before they put it on the market. And the long-standing average, you can see this down here, has always been around 6 years. And when you think about it, this actually makes sense because your life is changing a lot every 5 to 6 years. People are getting married and they're having babies, then the babies are growing up, they come to school age, so now you need a better school district. Then maybe there's a job-related relocation, or the kids are going to college, etc. So with every single one of these steps, the needs, the housing requirements are changing. And without the restrictions from an external force, people will just decide, well, we'll sell this house and we, either upgrade or downsize to one that meets our current needs. That makes a lot of sense. Until 2008, when we had the subprime crisis, and following of that, the financial crisis, and then the housing market was kind of crappy. So people did not want to put the house on the market. Maybe they were low on equity, so they just decided to stay in their house and make it work. Maybe they did some remodeling, but they did not put the house on the market. So because of this, we have seen the average time go from 6 years to 10 years. But the underlying reasons why people wanted to sell their house was still there. Life was still moving on. Their family was still growing up and changing. So it was just an external limiting factor that kept them from putting the house on the market. And then COVID came, which was another good reason for not selling a house, because who wants to have 50 strangers, walk through the living room in the middle of a pandemic lockdown? And it looks like, hopefully, we're getting slowly to the end of the pandemic. I'm certainly seeing it in the marketplace that more and more people are now really ready to that point where they say, okay, no more. We are going to put our house on the market and we're going to either buy a bigger or smaller one, depending on what we need. COVID itself actually provided another reason for them, because now with remote working, maybe one or two of them are working from home. So now you have the need of additional home office space where you can close the door and have quiet time, and you can actually get some work done. So this is why we are seeing now a change in behavior. And those changes in behavior are always interesting because they change the marketplace. Just we have seen that ramping up here after 2008, that certainly changed the marketplace. And even though we have only one data point now, I'm seeing this anecdotally in the market already in the last half year talking to people. We might see a change of a trend here. So this is something to keep an eye on. Now, next thing to keep an eye on is inflation. So consumer price index came back with 6.8%, which is quite high. You have to go back 40 years to see 7% inflation. And that is going to have a big impact on not only the real estate marketplace, but on all marketplaces, because it shifts everything that has to do with the dollars that things are being paid for. And what has also changed is the Fed used to say, don't worry about it, this is only temporary. As soon as the supply chain issues are going to be resolved, inflation is going to come down and we're going to be fine. Now, you have to understand, it is the job of the Fed to manage inflation expectations, because inflation tends to be a self-fulfilling prophecy. If people and businesses are anticipating inflation, it tends to happen. So this is why the Fed will always send calming signals to the market. But now Jerome Powell came out and said, you know what, this is not transitory. We are going to see inflation for a while, and we're taking this serious, and we're going to take active countermeasures. And they have announced they're planning to increase interest rates 3 times in 2022. So when the Fed starts hiking the rates, remember they have been at 0 for a long time. They tried to raise them just before COVID. That didn't go so well. So now this year they're trying to do this again. And they're trying to do this without crashing the economy. So this is going to be really something interesting to watch for. Now, inflation and home prices. I've spoken extensively on my last video about this, but just keep in mind when you look at Milwaukee and you see 11.6% increase in home values, you have to subtract the 6.8% inflation from that. And that makes the actual net increase of the home values a lot more palatable than what we're seeing. So the fact that home prices are going up, like crazy is, partially just because the dollar is losing value, which is inflation. So that is happening. Another observation that I have is a lot of people are looking currently mostly at increases in their expenses. So they're paying attention to gas prices, they're looking at the grocery store prices, and their focus is really on those things. I think the general public has not really looked hard enough to see what is inflation going to do on their retirement, on their 401k. What does that mean for the savings? Because if you have $100,000 in a savings account and you expose it to 6.8% inflation, that basically means after a year you have lost $6,800 in purchasing power. You do this a few years in a row, and your retirement fund has shrunk significantly in actual purchasing power. And this is going to be a consideration. And whenever you see a lot of inflation, money tends to go into hard assets like real estate. So, that is another factor where we can see additional demand coming from, because people are trying to move their money into something tangible, into real estate, for example. So something we'll keep an eye on and see what's going to happen. Mortgage rates currently still on a historic low, a near historic low at 3.1 is the number that we have from Freddie Mac here. Rates are expected to rise in every quarter now. In the next year, we're going to see an increase, and this has not impacted the market yet. But I think what's going to happen is as soon as mortgage rates start going up, it will be in the evening news, and then they will say mortgage rates are going up, and that makes houses less affordable, etc. So as soon as this becomes mainstream information, it's going to impact the real estate marketplace in a way that increases the urgency of people who are buying homes, because they want to lock in the new home before the rates are going up too much. A little bit of a rate increase everybody's okay with, because it changes your mortgage payment maybe by $20 or $50, that's all right. But people want to do it before the rates are going up too much. And this will drive urgency in the marketplace that is already very hot. Now here are the forecast numbers for the next 4 quarters, what we're going to see for mortgage rates. And I've averaged them out here on the right side. You can see we're going from 3.3 to 3.7 by the end of the year. Now, this is not based on the Fed raising the interest rates. That is something different. It's similar, but it's different. I think it's important to understand the difference. So how does this work? When a bank is lending out money for mortgages, what they do is they bundle those mortgages and then they sell them off as securities to large investors that are buying those securities as an investment vehicle, for themselves. They're considered very safe investments, and they're called mortgage-backed securities because they're backed by those mortgages, by actual real estate, and by homeowners who don't want to lose their home. So there is a marketplace for these mortgage-backed securities, and of course there's supply and demand, and it's exactly this supply and demand for these mortgage-based securities that are driving the actual mortgage rates. So this is not the Fed raising the rates, it's actually supply and demand on the securities marketplace. Now, the way the Fed is still impacting this is they are the largest buyers for these securities. So if Powell is reducing the amount of securities that they're purchasing every month, they're changing the supply and demand equation on that marketplace, and that actually makes the mortgage rates go up. So far we haven't seen that, but the prediction is it's going to happen in the first quarter. Now, with rates going up, that raises 2 questions that I'm trying to answer here. Number one, what is this going to do for home sales? And what is this going to do for home prices? So home sales is just the number of homes that are being sold. And I have here some historic data that you can pause the video and look through it. But the number of home sales are not impacted by rising mortgage rates. And why is this happening? This is happening because if somebody wants to buy a home, that's a life decision. If interest rates go up a little bit, it doesn't change their situation that much because it doesn't change their mortgage payment that much. It's maybe a $20, $50 increase, but it does drive urgency like I mentioned before. And when you look at this, what is happening, what is forecasting for home sales on a national basis, for 21 and 22. You can see last year we've sold 6.5 million homes. This year we're going to land a little bit higher, maybe 6.8 here. And then we have the projections for the 2022 market which are going to be most likely more homes being sold in general than we have seen this year. So another record after the 2021 record year. Now, second question was, what is it going to do to home prices? So there is going to be a little bit of an impact of increasing mortgage rates to home prices because it reduces the affordability. And that means if you're on the top of your affordability and your mortgage rates goes up, your pre-approval letter is going to be a little bit smaller because you're paying more on interest. So there is going to be a dampening effect. And, I think that's a healthy thing because home prices have been kind of running away this year anyways. So I think that is healthy if we're slowing down with home price appreciation, and rising interest rates will do that undoubtedly, even though you can see the impact of that is actually kind of small. So in my personal estimation, as long as we're staying under 4%, that doesn't make a big difference to most of my buyers. We're in the Midwest, so we don't have these ultra large mortgages of $1 million and over. The bigger your mortgage is, the more you're impacted by a higher interest rates because it's causing a larger swing. We're still a relatively affordable market, so we're not as susceptible to changes in mortgage rates. And what does that mean for home price forecast? So the average forecast for next year is going to be plus 5.1%. And personally, I think that this number could be a little bit low. First of all, you have to add inflation on top of that. So depending what inflation ends up being, remember the Fed used to say, no, it's only going to be 2 or 3% next year. This is what these forecasts are based on. So if we actually see, we're now at 6.8%, let's say that trend is going to continue, then you have to add that 6.8%, at least a portion of it, to these home prices. So I would not be surprised if the price gains, the price increases we're seeing in 2022 are going to be more than what is currently anticipated. Other factors that are influencing that, we still have a supply shortage. We still have millennials aging in their prime home buying years. They're coming from a place where they're not selling a home, so they're just sucking up houses because they either live at home or they live in a property they've rented. So they're taking up a lot of supply from the market, and that's only millennials. You also have Gen X, my generation, and you also have baby boomers that are competing in the marketplace, and the first Gen Yers that want to buy their houses. So we are going to face continued shortage, and that's going to take, according to the latest estimates, maybe 8 to 10 years before that shortage is filled in with increased construction of new homes, because we have just dug ourselves in such a big hole after the 2008. Depending on who you believe, the US is short between 5 and 7 million homes, and it's going to take a while until we fill up that demand. Also, the cost of new construction is increasing, and the cost of new construction impacts existing homes. Remember, we have wages going up, we have supply shortages, material are going up, lumber has come down now, but in general, it doesn't matter, from flooring materials to nails to lumber and windows, everything is going up in price. That means new construction is going up in price. And when new construction goes up, it's kind of the benchmark for existing homes, because a lot of people have the choice between new construction and existing homes. And if somebody says, well, new construction is too expensive, we don't want to pay $900,000 for a new construction home or $700,000, we are going to pay $500,000 for an existing home. And from where they're coming from, they have much less of a problem to pay $10,000, $20,000 or $50,000 over asking price, because it is still a lot cheaper than what the new construction home would have been for them. So that is always an influence on the marketplace as well. So generally speaking, we're expecting home prices to go up in 2022. There's a lot of reasons for that. There's currently absolutely nothing on the horizon that is suggesting the opposite. But we're thinking that the increases, the gains, will probably be a little bit lower than we have seen this year. Next slide here is a very high-level overview on months of inventory. So you see here on the left side months of inventory, and 6 months worth of supply of inventory is considered a normal and neutral market. And you can see how much inventory we used to have, and then how long it took to actually go down with inventory, and where we are now in December 2021. We are very deep in a seller's market. We're very low on inventory, and it is going to take a long time to build additional homes, to build up inventory in order for us to get out of that supply shortage. We need a lot more homes, and I'll keep eyes on this and keep you posted on this. So you're going to see when we're starting to see a change in trend here. All right, that was a lot of information that we've covered, and as always, I'm trying to keep it as short and as condensed as humanly possible, but give you all the information that you need to understand what's going on in the Milwaukee market. YouTube is incentivizing me to make longer videos, but I know a lot of you guys personally, we've done business together. Your time is valuable, and I want to respect that and want to keep my videos short and condensed. If you appreciate that and you agree that, please give this video a like. That helps my channel, and I promise I'll keep the videos short also in the future, and we'll get right to the point. Speaking of the point, what does the crystal ball say for the next 4 to 6 weeks? Relatively easy this time, because the remainder of the year is going to be relatively calm. People are busy with holidays, and that is going to change very, very quickly on January 1st or January 2nd, depending on how bad the hangover is, and then my phone is going to start ringing. So we are ready for 2022. You can see that my team has grown, so we have more people on board now to provide the same great service, if not better service, to you, to our clients. That is very, very important to me. So we're ready for this. If you are thinking about making plans for 2022 in your real estate life, then feel free to reach out to me and we can discuss your ideas. I can give you some feedback. You can reach me on my cell phone. You can send me an email, or if you want to, you can go on my website and schedule a Zoom call with me. Thank you very much for watching, and I'm going to see you next time.